Hi all, today we're going to talk about SMCI. We're going to go over their financial results. We're going to see what the results are and what the guidance is for the next year. Probably going to explain some of the things which are not really clear from their balance sheet and from their profit and loss statements. And then we will do a small valuation of the company and just to show you how ridiculous the stock price currently is. Alright, so a couple of days ago SMCI announced their Q4 results and actually also announced that they're going to split their stock finally. They're going to split their stock on October 1st, 2024, split 10-1, basically like Nvidia and Broadcom did earlier this year. The results were not wow. Currently the market is very nervous. And you probably seen it. Some days we have plus 3% in Nasdaq and S&P. Some days we have minus 3%. And some of the days everyone is really excited and really optimistic about the markets. The recession is here. Fed screwed us all. Stuff like that. In conditions like that, for the companies, it's better not to miss any expectation. And SMCI did that. They missed the earnings per share expectation, missed it quite badly actually. And there were concerns about their shrinking gross margins. Since then, the stock fell 13% I think in the pre-market. Right now it's trading in around 500 territory. It was more than $1,000 just a couple of months ago. So the stock fell about 50% over the last couple of months. Today we're going to go over the financial results and kind of make the sense of all of this. So let's start with the revenue numbers. Revenue numbers were good. The expectation was for the company to sell for $5.3 billion and the company overdid it by like 80 million, so beat the expectation but not by much. But we can see the amazing growth of the revenue from the company, so 143% year over year. What's really amazing, it's almost 40% quarter over quarter. So yeah, we know that SMCI kind of grew a lot this year, but they actually grew a lot compared to the last quarter. What really amazes me here is if you can see the pie chart, at the bottom of the pie chart it says that China is less than 1% of total SMCI sales. Just imagine to yourself, if we didn't have these trade wars between US and China, how much more would SMCI sell over the last couple of years? By the way, if you find this information valuable, please subscribe to our channel and of course like this video. So if we take a look at the revenue mix, nothing really interesting here. Pretty much everything stays the same. I don't have anything important to add here. Let's go over to the kind of elephant in the room for the gross margins. So gross margins this quarter were around 11.3%. And you can see this is a drop. This is the serious drop. Let me explain for a second what gross margin is and why are they shrinking. Gross margin can shrink because of two scenarios. Scenario number one, you made a product, you sold it for a lot of money, and now you have a bunch of competitors in the market, so you cannot sell it for the higher prices you were accustomed to. Now you need to sell it for lower prices, and now the kind of pricing war starts between the companies. You have to lower prices, gross margins shrink. Stay until the end of this video, by the way, because I will be doing some valuation of the company just to show you how ridiculous stock price is right now, given the financial information that we have. And after that, I will give you some of my thoughts about SMCI and how I'm investing in it right now. The second reason is the production cost. If the production costs are growing, your, again, gross margin shrink and your profit is shrinking for kind of the same revenue. What happens with SMCI is a little bit of the both. The company actually talked about this during their earnings call. The CFO and CEO of the company said that, first of all, they have a lot of orders from hyperscalers right now. What they're referring to as hyperscalers is these huge companies which have data centers and which order a lot of equipment. The Amazons, Microsofts and Facebooks or Metas of the world. Basically what happens is that if SMCI, for example, sells their racks for $10,000 a piece, basically Amazon can go to SMCI and say, guys, we will buy for $8,000, but we will buy 2,000 pieces or even more. So bulk order, but for lower price. This thing shrinks your gross margins. The next thing is the technology which is called DLC, direct liquid cooling, is the new technology to cool these huge racks which SMCI is producing. It's much better for power consumption, at least that is what SMCI is claiming, and as we know, power is everything right now in this business, because we actually have a video about that all of the data centers, all of the hyperscalers are really worried about where the power is going to come from. This is a problem right now, and SMCI is trying to solve this problem. They are claiming that their racks consume much less energy, first of all, and second of all, much better for environment because they are using some kind of a liquid cooling, which is better for environment than burning coal, apparently. Good for them. So the margins shrank this quarter and shrank a lot. We can see that the margins were around 17-15% over the past couple of quarters. This quarter they are 11.3%, and this is a major point of concern for all of the investors. The good news, the company knows this is the problem. They addressed this problem, and the guidance for the next year, we're, by the way, going to talk about the guidance a bit later, but the guidance for the next year about gross margins is to get them back between 14 and 17%. If the company manages to do that, that would be awesome. On the next slide, we can see operating margins and operating expenses. You can see that operating expenses are growing, but the company is growing, so nothing substantial to add here. The operating margins are shrinking, but I just explained this is because gross margins are shrinking. If we take a look at earnings per share, $6.25. The guidance was between 7.6 and 8.4. The company missed the earnings per share stuff. This is really bad. Like, the company missed it by almost 20%, their own estimation, and that's why the stock dropped so much in the recent weeks. One more thing I wanted to talk about is the inventory and accounts receivable. If you remember our previous video about SMCI, we have talked about SMCI wanted to have bigger inventory. Their management told that over the past year and a half, they could sell more every single quarter. The problem is they didn't have the inventory to do that. Right now, kind of the whole game with AI technology, AI hardware for all of these hyperscalers is also the speed with which you can deliver the final result. And what SMCI wanted to do is to build a huge inventory, so if they have a huge order from Amazon, they don't need to go to their suppliers, order some stuff, build the racks, and then deliver them to Amazon. They have everything in place and they can build it much faster. And the company achieved just that. Their inventory is about $4.4 billion right now. If this seems huge for you, the inventory turnover cycle for the company is around 82 days, which is pretty amazing. If you think about it, $4.4 billion of inventory the company can sell in 82 days, and this is a sign of very healthy business. So for accounts receivables, the company has 2.6 billion. If you into reading financial statements of the companies, you might get worried about that. Usually it's not a good sign when the company has a lot of kind of accounts receivable and obligations from other companies to pay them money. But again, think about who the customers of SMCI are. They're not some small weird companies that can go bankrupt and not pay everything. These are Amazons and Microsofts and Metas of the world. So accounts receivable cycle is right now around 37 days. Absolutely no worry here. The company in 90 days can bring around $9 billion to its balance sheet. The cash flow of the company is negative. The reason for the cash flow being negative is because the company is pouring everything they have, including, by the way, issuing some debt, into kind of developing the company, developing new sites like the Malaysia site, the Taiwan site they have, and the one more in California, which they are building right now. The company tries to grow and tries to grow very aggressively and very fast. Let's talk about the guidance of the company, because this was the best news out of the Q4 results. The guidance kind of blew everyone away. Nobody was expecting that. So the company grew 143% year over year this year in 2024, and this was a huge year for the company. The company sales is around $14 billion, which is very impressive. The company guided to double their sales over the next year. They are guided to have sales of between 26 and $30 billion, which is kinda crazy. So the company actually prepared itself for the growth next year. The guidance for earnings per share is between $6.7 to $8.2 per share, which is pretty good. And the guidance for gross margin is between 14 and 17%. If the company can achieve that, let me show you just a very quick valuation, in the spreadsheet, just how ridiculous the stock price is right now. To do this valuation, we will take what the company is guiding for. We will take the revenue of $30 billion and assume that. We will assume operating expenses of around 4% of the revenue, so $1.2 billion. We're not inventing anything here. This is what their operating expenses are. We will assume taxes of 14.6%, again, what they have today, so no kind of crazy assumptions that they will stop paying taxes. And let's take a look. So if we take the most conservative approach, gross margins are 14%, so kind of the lower bound of what the company is expecting to have. We have revenue of 30 billion, gross profit of 4.2 billion, operating expenses, as we said, 4%, 1.2 billion, minus taxes, we are getting to net income of $2.56 billion, which gives us earnings per share of $38.8. Given the price that the company has right now, I, by the way, assume the price of $515 per share. I'm not sure what the price is when you are watching this video, but probably not very far from that. So assuming this price and assuming the company has 66 million shares outstanding, that's what they have on their balance sheet right now, the price to earnings ratio for the company is 13. Again, price to earnings ratio for the company, which is expected to grow its sales by 100%, is 13. I'm not even going to try to calculate what the PEG ratio is because it's insanely ridiculous. Now, if we go to kind of the middle point of the gross margin estimation, let's take 16%. Again, we have the same thing, revenue 30 billion, gross profit of 4.8 billion, net income 2.89 billion, and earnings per share of around $43.8 per share, and we are getting to the PE ratio of 11.8. I will kind of spare you the rest of the calculation, but if we go to the highest point in their projections of gross margin of 17%, we're getting to PE ratio of 10.2. So currently you have an opportunity. You have an opportunity to pay 13 to 10 PE ratio for the company, which is expected to grow 100% next year. I have to say, I myself own shares of SMCI. I will add more shares of SMCI. I like this company a lot. I like their management a lot. I actually really like the presentation which they're doing, because all of you engineers out there who are watching this video, this was done by an engineer. This is not designer's work. So after all of the sleek presentation and kind of futuristic stuff from Palantir, watching this is awesome. It's like one engineer sending information to another. It's very ugly, but it's very useful. Love this company, love the management, and we will keep track on it and report on every news that happens to SMCI. If you like this video, like it. If you haven't subscribed to our channel, why the hell not? Please subscribe to it, and we will see you in the next video. Take care, guys.